say make money, money, make money, money, money. Make money, money, make money, money, money. Money makes the world go round. I'm the talk around town.
Welcome in to Just the Tips. This is the initial podcast of George, Bruce, and Gordon here talking stocks. We're just three guys who like stocks, and we want to debate the bull and the bear of a stock here every once in a while and talk about some of the things in the news and hopefully have a good time while we do it. So we don't want to be one of those put you to sleep snooze finance podcasts. We're just three guys shooting the shit and talking about how to make some money. So we're
three best friends. Okay.
The three best friends. There we go.
Wild and crazy guys. All right.
Gordon, I didn't know you had a singing career.
No, I definitely don't.
All right. Maybe since this is the initial pod, why don't we talk a little bit about our backgrounds and our qualifications here? None of us are necessarily on Wall Street today, but I think all of us have some background in stocks and tech and different areas and bring some different perspectives to the table, which hopefully lend us some credibility here. I'm going to kick it over to Bruce. Why don't you start? Tell us a little bit about yourself and maybe your investment style, things like that, whatever you want to share with our audience here.
Thanks, George. Great to be on the podcast. Just a background on me. I spent my first 5 years on Wall Street at a big investment bank doing a bunch of kind of analyst work, covering a bunch of technology
So you were
companies.
Buried in spreadsheets,
After
is what you're
that,
saying.
I was buried in spreadsheets and
Models and bottles?
Not very many bottles, but a lot of
Post-Spitzer.
models.
So lame. All right. You look too young to have been models and bottles era. Okay.
After that, I spent about 5 years on the corporate side, working at a big tech company, and then about 5 years on the buy side. And since then, I went over to another part of the buy side, which I'm keeping everything relatively ambiguous, but spent a lot of time around technology, spent a lot of time around enterprise software. So got to know the technology universe, both on the East Coast and the West Coast. I'd say my style of investing is I'm more of a value-based investor than anything else. I think that I'm more biased towards the fundamentals of a company. I would say looking at the long-term perspective of a company, looking at the sector, looking at the market, looking at the team and the opportunity. But I'm guided more by valuation metrics than I would say anything else.
So that's why you were pitching me Bitcoin for a long time, huh?
It's digital gold. It's digital gold, George. I've been trying to get you into it since 2013. I think it would have probably returned more than most of our portfolios.
I know, but you didn't tell me how to value it. That was the problem. I've got one other question from your bio. What's the difference between West Coast investing and East Coast investing? Like West Coast rap versus East Coast rap? Is there a big feud here that I'm missing?
I think West Coast investing is more with your heart, and East Coast investing is more with your head.
Modes. You're a bunch of modes on the West Coast. Yeah. What's New York now?
West Coast investing is all about FOMO, especially when you live in Silicon Valley and everything's going up. You constantly feel like you're missing the next thing. When you're surrounded by trillions of dollars of market cap that's going basically up and to the right for decades at a time, it's impossible not to feel FOMO. So I think West Coast investing is just lead with your heart and hang on for dear life. East Coast investing, I think, is more based on models and bottles.
It's hard. I've never heard it just being like a freaking mo. Okay, I'll put that in my repertoire.
All right, Gordon. Let's hear it. What's your background?
I'll flip it over to you, Gordon.
Oh my gosh. So I started on the dark side, on the sell side, and mostly kind of a hardware skew. I grew up in a place where you had to come up with the data points, right? You had to do the checks. It's like that speech in Wall Street. Who has the best information? With all the legal important guidelines for that, of course. People are often confused by it that aren't from the field. But my cottage industries tend to be pretty short-term in nature, and I didn't love that kind of investing style, frankly. I believe in truth. I'm a fundamentalist. I also get really enamored with valuations. And my favorite thing to do is lose as much money as possible shorting things that just look way too expensive. It's like my entire calling card. It's really useful for anybody who needs a contrarian indicator. Yeah, or likes to lose money, who needs like tax loss harvesting, anything like that. I can tell you, I'm like a moth to flame. I will help you burn lots of cash. But yeah, my favorite thing to do is get long dated put with a really expensive carry. Tesla, I tried to short, but yeah, I'm a fool. I believe in truth and in value, and I'm a cynic. I became an investor relations professional. I did that for a number of years. I did an IPO. I worked at a tech company. And so I've seen the sausage. And I guess, frankly, what's shocking to me is how little we really knew on the sell side. And so I think that perspective is interesting, having been a corporate person, just like analysts that you see on TV, generally, I don't know what they're talking about. Like, I don't know that I have a great style other than I feel like I've been humbled by the markets, and I'm all about diversify, and your biggest edge as a sort of non-professional is having a longer horizon and not trading too much. That's my bias. Do I do that? I don't know that I really can point to a great track record of that, but that's at least my philosophy. But that's me in a nutshell.
Makes sense. I equate the sell side to a used car salesman. They're just flipping stocks instead of cars. It's you're selling something end of the day, and so you're not really motivated.
What's it going to take to get you into this little piece of garbage? What's it going to take?
And I say that from a place of knowledge, because I also spent a year on the sell side covering technology stocks. But I've got a background where I've done everything from private equity to public equities, sell side, buy side. I've done debt as well. I've done venture capital, and I've bought companies in M&A for other companies. Most of my career, I have been tech focused. Early on, I was natural resource focused. So I'd say those are the two industries that I tend to head towards quite a bit. I do like shorting, though I will say, unlike James, I will actually take some credit for my shorting. I generally like shorts that are fundamental business problems. When I've tried to short valuations, that's where I've gotten burned. I shorted Zoom for a long time. I thought it was just a much smaller market. Looked at that valuation and I had to eat it on that one a bit. But things like BlackBerry in the past, or those kinds of businesses that just feel like they've got a structural issue, those are my favorite types of shorts. And there's always some bull case that comes out on them and they spike up, and you get these little moments where you can just take the long-term view and they tend to work. I also enjoy the short quite a bit, but also like the longs. But
what's the rationale for you guys' love of the shorts? Like, it's so hard. The market has gone up 8% every year for the last 100 years. Why?
Because you know you're right. And you're so definitely right.
The track, even short hedge funds get paid on alpha, not on absolute return. Like, it's impossible to make money on shorts.
See, I'm a purist. You're a pragmatist. I also like to watch it burn. I'm like the bane of investing, right? I don't know. I guess I like to watch it burn sometimes. It's like, it's my sense of justice too, right? It's like, these crooks, they're such idiots. Anyway, it's just, for me, it's an emotional appeal. To me, it's just far easier, right? It's much easier to see when something is just way overvalued. When there's not a catalyst, it's really hard to take advantage of that. It's annoying that way. But for me, let's see with NVDA and try to figure out, should it be worth $3 trillion instead of $2 trillion? That takes knowing a lot about the future. To me, there's
something just very intellectually satisfying about being right and betting against a management team who's trying to talk up their stock and convince everybody else and all these sell side analysts. To the point of sell side analysts being salespeople, like, how often do you see everybody a sell in a stock? By the time they're all a sell, it's practically bankrupt, right? And so, to me, there is opportunity to make alpha there. I think the market, generally goes up, but you pick the right ones, it is a way to generate alpha. So I found it as a nice protector. And then in a down market, you have something to cheer for. If you're 100% long, you're always angry.
The problem
when
is,
the market
even
goes
if you
down.
generate alpha on a short idea, you won't necessarily make an absolute return.
Why not? On one short, you got to have a portfolio.
The market could be up.
Have a portfolio.
The market could be up 20%, and your short could be up 10%, and you made 10% of alpha.
But losing 10% in that short feels better than making 50% in the long, honestly.
I'm not shorting to do better than the market, but then you should be taking those proceeds and putting them into that 20% as well. So you're getting leverage on that short.
I'm selling a lack of correlation, not necessarily returns. Which is a great disclaimer for this podcast. None of this is advice. If you follow anything that we say, you deserve a chance. Talk to your financial professional.
Exactly.
Seriously, my lawyer says that we have to say that.
Which I'm sure you've consulted in depth before this, right?
I got a deep bench thanks to all my ex-wives and my choices.
I'm sure divorce lawyers make excellent security professionals as well.
Yeah, they really do. They really have great stock tips.
By the way, did we even say the name of our podcast when we came in here? Just for everybody listening, this is Just the Tips. So this is your new stock podcast. And anyways, we quite enjoy the name.
Refers to stock tips, to be clear. For the children listening, we're talking about insights. It's a synonym for insights. Just the insights. No BS, no promotional hogwash. We're just going to stick a small amount of insight into your brain. Stimulate you.
Oh, yeah. All right. So...
Room.
Moving on.
Jeez.
All right.
Tip your waitresses. I'm here all week. And no, I didn't do any cocaine, Bruce. Be cool, man. Don't make it weird.
It's the Wall Street way, right? Gordon Gekko, doesn't he take a little hit here and there? I guess they don't show that in the movie, right?
That's right.
I thought you had to do a little just to get your heart started every morning.
Yeah, that's right. I hot bang it. My wife injects it. Give me the first wave, honey. It's like Elvis. All right. Back to the topic at hand.
Wait, I don't know what that is. Hot. Please explain that for me.
I had something to do with like mixing heroin and or cooking it. I don't know, man. It's just something I heard in a movie. I don't actually hear it myself. My wife does it.
I thought you were the expert here, so that's not what you did before this podcast to get ready?
No, it's not. I slapped myself over and over. All right. So let's get to it.
Let's talk a little news. We need some sound bits here, Gordon. Since you were singing in the beginning, you want to sing a little news piece for us? I feel like we need like a news jingle.
That was like my news.
It's like the 1960s, like breaking news.
Financial news. Just the tips with host. Who's hosting this segment? I guess that's you, Georgie.
Giorgio. Jorge here is hosting. Anyways, to the news at hand. So this week, one of the stocks that I follow closely, Palo Alto Networks, which is a security vendor, traditionally a firewall vendor, but provides a broader suite of security products, and that is security for your cloud and data centers, reported earnings that were disappointing, or I should say a guide that was very disappointing. In and of itself, I would not call that newsworthy. I think the stock ended up going down, call it 26, 27%, maybe even 28%. This is all off of memory here, but it was a significant hit for what was a highly valued stock. What's more interesting, though, however, is they were one of the first to report in the security sector, which has been a great sector. If you followed the security stocks, they've been up and to the right. It's, for me, like I always love that sector because there's always new threats that create basically additional revenue opportunities. You never solve the problem, right? There's always something new to solve. And so great from an investor's perspective. But those stocks have all been gangbusters. You look at CrowdStrike, Zscaler, most of them have been doing fantastic across the board. However, Palo Alto, who's one of the larger cap names there, said that they saw a significant slowing in security spending. And anytime you see that's a big red flag. And so all of the security stocks went down in tandem on that news. And so the question I think at hand that was interesting, is this a Palo Alto problem or is there truly a shift in how people are spending? Bruce, I know you spend a lot of time thinking about security. I don't know if you have a perspective there.
Yeah. So I think part of the issue was, I think, the messaging of how they were thinking about the guide. So Nikesh Arora, the CEO of Palo Alto Networks, came out and said that instead of pursuing a strategy where they would effectively sell individual components of their platform at sort of full cost, they would move more towards a model of platformization, which is basically another way of saying we'll bundle everything we have in a singular package and we'll sell it to you. And we're willing to take a hit on the cost of the individual offerings that you don't purchase for us until your current vendors' contracts run out, at which point we will start charging you. What that implies is a big kind of bookings hit to the company in sort of the first year that they're running this platformization strategy. And the view, I think, from the street was that this is an attempt to compete against Microsoft. It's an attempt to compete against probably CrowdStrike. It's an attempt to compete against hundreds of little startups that are building individual solutions in different parts of the security ecosystem. And the idea is over the long term, this platform strategy will actually yield bigger and better results by enabling Palo Alto to take market share from both the big vendors and from the small vendors. I think it's a very risky strategy. I think Palo Alto has built, prior to the report, nearly $100 billion business on bundling a solution in different pieces that is sometimes best of breed and is sometimes not best of breed. I think taking this strategy where they're trying to win the hearts and minds of all of their small and medium and large customers is very difficult. Typically, I would say the larger enterprises are always going to buy best of breed offerings because they can't risk using a second tier or a third tier solution because security is paramount to everything that they're doing. It's a foundational principle of most enterprises. And so I think it's a very risky strategy. We'll see in the next 12 to 18 months if it plays out, but it is, I think, a testament to maybe what they're seeing in the market in terms of broader security headwinds. But it's also, an interesting time to make this change when they were effectively at their all-time high. Revenue is at an all-time high. I think a number of customers are at an all-time high. I mean, everything that Palo Alto has done for the last, 2 to 3 years since Nikesh has taken over has really ramped up the stock, ramped up their valuation, and ramped up their broader offering. So I think it was both an interesting move, and I think even more broadly, it was a really surprising move that most people didn't expect, I think, from the company that's basically considered one of probably the 3 biggest and best companies in cybersecurity.
Yeah, and it looks like...
Yeah, I'm just pulling up. You guys see that screen share? You guys see that, right?
Oh, yeah.
Yeah, I'm just sharing the EV sales. We can look at earnings, too. It wasn't cheap. It's certainly nothing like the heady days of 2021, but 13 times sales for this is next 12 months for a company at this size certainly was not super cheap. And I don't know, I'm definitely, this is not my area. I know it's SaaS more broadly. I think people have been trying to reduce subscriptions and kind of everyone's feeling the cloud optimization. I know security feels that too. People are looking for data they can delete so they have to pay for it, looking for seats. They're laying off a lot of people. We basically didn't add any tech jobs last year. It's not a lot of seat growth. So I don't know if there's some macro aspect to this too. These management teams, I gotta be honest with you, man. My experience is they don't always tell you the whole story, and they're always it's in their interest to show you the most positive light. And the explanation they give is take a grain of salt that I've been trained to do. But what do you think as a security guy, Bruce? Is any of that influencing?
I think it's just a strategic shift that I think is more directed at the largest vendors in the space than anybody else. I think Nikesh has made his mark on the company since he joined, but I think he is taking another shot at becoming even bigger. And he realized that in order to do that, he needs to transform the company. I think that the big kind of 800-pound gorilla in the room, Microsoft, has gone from basically $5 billion in revenue to $20 billion in revenue over 2 years, just consolidating everything and selling their E5 license to the broader enterprise, even though I think most people would argue that the composition of their products is probably worst of breed. Microsoft products are some of the most targeted products in the world. They have some of the most breaches, but if you can buy a singular offering that's bundled together instead of trying to figure out who the best vendor is in each space, it works really well, especially at scale. And so I think that the view from Palo Alto is in order to enable us to compete with this next generation type of platform or next generation type of pricing structure, they needed to platformize their own offering.
I will add.
I don't know if there's.
Go ahead. Sorry, didn't mean to cut you off.
Yeah, just to Gordon's question, I don't know if there's a read through around broader weakness in the cybersecurity space, any ulterior motives on the executive management side, longer term headwinds here. It's hard to tell. It was just such a surprise that everything from the messaging to the numbers, I think, shocked everybody. So it ended up, I think they ended up losing.
The cynic in me is they're saying, hey, everything's slowing is because we have this necessary strategic shift that's happening, not because there's some kind of near-term perturbation in the business or end market is slowing. Because that's a shitty explanation, the second one, right? If that's true, then you deserve the re-rating and there's nothing to wait for. But the story that you're telling, the management's telling, is like, oh, it's a temporary thing, it's a shift, like, look over here.
Yeah.
But not to be cynical, but that just, it feels like these big shifts always come with really bad news. Like, they just haven't been timed that way, and so the cynic in me just has to ask. But you're way closer to it than me.
I will add one other cynical point there. So if you go back to the quarter before when they reported, it was also a disappointing quarter on backlog, and you didn't hear as much of this explanation. And the stock actually initially went down, and then for whatever reason, it started just trading up, and it was literally up and to the right. So the market had a different view. But the initial read through was the backlog was really disappointing. So this isn't one data point. This is now 2 data points. And so that raises my radar.
Right?
I'll tell you, I was a Palo Alto shareholder, and I sold right before this quarter based off of fear from the previous quarter. So I feel pretty good there. But I will say, like Nikesh, like I actually admire him as a CEO. I think he's bold. I think he's highly incentivized. He has one of the bigger pay packages in the industry. He's made a ton of money, but I think he's swinging for the fences, and he's not scared to do that. If anyone were to do that, I think it would be Nikesh. But I think there's a lot of reason to be trepid here, and I think we just continue to watch the results roll in.
Good foreshadowing on, make your CEO rich to make the stock work. But that's a Supermicro. It seemed to have worked. We'll come back to that in a second.
Yeah, absolutely.
An approach to incentive, sending employees is telling all the employees that you guys are going to make me really rich if we succeed.
Elon would say, if you're going to do that, go incorporate in Texas.
I incorporated in Texas, so to speak.
What kind of pay package did you negotiate with this podcast? I must be unaware.
This is another tax sink here. I have lots of losses. Anyway, any other news we want to hit?
Yeah, let's hit 2 other ones just really fast. We don't need to discuss them a lot, but I do think one that's helpful. I think the Fed impacts the market quite a bit. And so one that I'll just hit on quickly is there's been a narrative in the market, right, that the Fed was going to cut rates this year. They had finished raising, and then inflation data continues to come in hotter than expected. And so you had the Fed this week, you had Barkin talking, and he was downplayed January's inflation data and said they're still confident on disinflationary trends, but they want to see more evidence. And so he did say it made it harder for the Fed to consider any sort of rate cuts. Productivity metrics are poor. Hiring is not back to normal yet. In fact, in the tech sector, you see quite the opposite, right?
They're not going to bring the punch bowl back. How lame is that? Markets hate that, right? We want the punch bowl.
Yeah, they want the punch bowl. And so a lot of things have rallied with this expectation, right, that the Fed's going to cut. And I don't think they've ever really committed to that. And if you're the Fed, like, to me, why would you cut? You got a Goldilocks scenario right now, right? Like, the economy is humming, but it's not too hot. It's not too cold. It's going. And so, like, why do you disrupt that? It feels almost like you're in the right spot. So unless their mandate is not growth, their mandate is inflation. So to me, I think the market is way over-rotated, a cut. But don't know if you guys have a different view on that one.
No, I actually would take it a step further, and this is going to be my hot take for the news section. Woo! I actually think that
burning the Fed
up. Has
your sound effect for hot take. Coming in hot.
I think that the
Mother
Fed,
Nature, put on your pantsuit. Here we go. Whatever.
I think the Fed has one more rate hike at least left in it. I think that they have a Goldilocks scenario that they can use to crush inflation. Unemployment is at historic lows. The economy continues to do well. The market is ticking up near all-time highs, and inflation is still running hot.
Yeah.
So I think the Fed has the opportunity to put in one more hike, maybe 2 more hikes, and really try to crush inflation before needing to have to put in some rate cuts to stimulate either economic growth or to stimulate employment. I think they're in a situation where they should potentially hike.
Yeah. So on that view,
It's tough, man. It's an election year, man. It's an election year. Raising interest rates in an election year doesn't, but getting, Weimar Republic style inflation in front of the election would not be good either. It's a tough spot, right? 30-year just hit 7%. To me, that's just very jarring. And
but the
to
economy's
continue.
working. It's working.
Yeah, I'm hoping that the 278,000 tech bros we shot, or whatever it is, will cut back on home buying and speculation or whatever they're Whole Foods purchasing, and there's going to be some softening in demand, and that'll cure it. You don't want to be probably rush into this stuff.
Well,
I definitely am more in your camp, though, or I would rather they err on the side of keeping inflation bottled up because the economy seems pretty strong. But
the tech bros
but
that
hey,
are working at NVIDIA, and maybe they'll move to our last news piece here, I think are going to be buying lots of homes. Unfortunate for those of us who live in Silicon Valley, or maybe fortunate if you're already a homeowner. But
Jensen's going to get a new jacket.
Black and leather.
You can afford it now.
I don't know. The black one has worked pretty well for him so far. I don't think he needs to change anything at this
Is it the
point.
same one? Is he wearing? What does it smell? Do you think? Anyway,
Money.
It smells like old
getting journalistic inquiry you get on this show. What does Jensen's jacket smell like? He throws staplers, by the way. I've heard word on the street is Jensen's ran a little tight. Maybe less tight now that he's worth $1 bazillion, $70 billion.
Staplers, swing line staplers.
Yeah,
what's the guy in the Office Space movie who loved his swing line stapler?
but that's my stapler.
The squirrels.
To date ourselves, people are going to realize that we're not Gen Alpha if we keep making these wonderful references to 90s movies.
Well, names like George, Bruce, and Gordon, I think they're guessing our ages already.
That's
23,
true.
24, and 25. Anyways, NVIDIA, which had huge expectations, crushed them this week with an EPS beat of 516 versus 454 being expected, a revenue beat of 22 billion versus 20.3, and a huge guide of 24 billion for Q1 versus what was expected at 21.5. And these were already hugely heightened expectations. A company has never skyrocketed, I think, in the way you've seen this company grow, really fueled by the AI revolution. What was also interesting was you had a lot of these kind of ancillary names that rallied off of the back of this that have now started to get associated with AI. You had folks like AMD, who's a hopeful participant here in some of this market share of GPUs, also rallied, I think it was 10 or 11% on the day, or at least at one point there. You had, why am I blanking on the name of it? The one that spun out from SoftBank. Whew, look at that chart. NVIDIA.
ARM.
It's a thing of beauty.
AMD.
Yeah, ARM, sure rallied. I like the chat. That's a good chat. Yeah, it's only $2 trillion in cap. It's only approaching. What was the U.S. GDP last year? Like 25 trillion or something. I don't have these numbers in my back pocket anymore.
Yeah, so it's almost 10% of U.S. GDP in a single year.
It's just
NVIDIA is now worth more than the GDP of every country except 11.
Oh, jeez,
that's impressive, dude. It's paradise, baby. It's a paradise of artificial intelligence. Look at that. Yeah, I really just find all this money being made on Wall Street very distasteful, just to be honest.
Which is why you do a podcast about stocks.
In my day, we didn't have trillion-dollar companies. We only had billion-dollar companies, and we liked it. So yeah, now there's 7 companies like with over $1 trillion in value or something. It's crazy, right? It's like Amazon, Google, NVIDIA,
Apple,
Meta, yeah, the company formerly known as Facebook, Apple. I think that's it, right? I can't count.
Not Tesla anymore.
Poor Elon.
Make it the Magnificent Six.
Yeah, that's right.
Sorry, Elon.
So yeah. So basically, this is just, it's getting a bit daunting. I think probably we could look at valuation too. Like, it's just like from let's just do earnings. That's a good equalizer.
I don't think it's as bad as one might think, though, actually, when you look at what the expectations are. If you could pull it up, it would be interesting to take a quick look at. I think from an EV to EBITDA standpoint, I was looking at it here just the other day. I want to say it was like 27 times forward.
So yeah, NVIDIA, you can see this year they're trading at 30 times, next 12-month earnings, which is like in the range for them. Like they were as high as like 65 times earnings. That ended up being a decent trade. Ha ha ha. They blew out numbers of that time period and grew into them. It's also interesting to look at like street expectations.
For our listeners that aren't as savvy on valuation metrics, when you say valuation metrics, you're talking a PE ratio. So it's the price of the stock to how much they're going to earn per share. And so if you take
Right.
the price per share of NVIDIA, let's say it's $700 as a basic example, and they're expected to earn $70 a share, you would take that 700 divide by 70, and you would get a earnings ratio or a PE ratio of 10. And so that's how it's calculated here. So we're saying NVIDIA is sitting at 30 times what's expected of the next 12 months of earnings.
I don't even know what the S&P would be right now. It's probably like 20, right? It's pretty expensive. But for a company worth $2 trillion to be trading at like a really very weak rule of thumb, and don't beat me up, guys. Let me just do this for a second and just say that a peg of 1 is not super standard, but that meaning like you take your price to earnings ratio and divide it by your growth rate. They can be like the same, and that's really roughly fairly valued. You do a lot of kind of gyrations around peg ratios. I don't want to go down that rat hole, but the point is you're assuming really roughly that these guys are going to grow like their earnings 30 order of magnitude bigger than the red box, right? If you look at the expectations this year, people are modeling the street's got 103 billion in sales after doing 58 billion last year, so almost doubling or leveling out to around 25% in 25 and slowing down after that. Obviously, they're going to get some leverage on that, I would think, right? You can't hire bodies this fast, right? Like you can't hire engineers.
They're a scaled model. They're a scaled model. It's the fabs that are slowing them down.
No, and yeah, so your net income is going from 50 billion to 60 billion to 73 billion. There's still some investment happening there, so their earnings aren't kind of growing as fast, certainly on the net income basis. But anyway, I look at this and go, could it happen? 30 times earnings doesn't seem insane. 30% growth on a company of 100 billion in sales doesn't seem that nutty. I don't know. Yeah. I think that this is one where it's very broadly followed. It's just hard to conceive. You tell somebody, how is it to buy a company that went from $1 trillion value to $2 trillion value like in a year? If I went to somebody 15 years ago and told them that, and then what's the rating on that stock by all? Everyone's got like a buy rating and massive upside, and there's nobody will say a negative thing about it.
It's true. I think it's true, but it's just, I think it's, as we think about the next segment here, it's just incredible to think about a company like NVIDIA that is moving the market with a single earnings report that was basically a pipsqueak, call it 2 years ago, relative to their earnings reports and their impact on the market. And maybe in text to take a step back, like how many times do you see a company go from 50 billion in revenue to 100 billion in revenue, to grow by 100% at that scale? I don't even know if it's been done by like the social media companies.
Maybe Facebook did it in their
best. And this is a hardware company.
Yeah.
So it's just remarkable. And the downstream effects are obviously being felt by everybody. And so it's just incredible to see it happen, I think, and to be around for this type of asymptotic growth.
Yeah, I'm not willing to kind of go on record betting against NVIDIA here for sure. I think that would be kind of foolish. But they weren't the company that was up the most, or that day. There was another company that was up more. A supplier called Supermicro. Right?
What an interesting company. I think we should talk about it a little bit. What do you think?
I'm feeling shy. Why don't you talk me into it? Why don't you sweet talk me into it?
We need a sound effect here. Ready, Gordon? You're our sound effect guy. We need like bull there.
Bye.
More drum roll, please. All right.
That did some amazing sound.
This is going to be the main part of the podcast. Sean's going to flip a coin, and one of us is going to take the bull side of a stock, and the other is going to take the bear side of the stock. And we're going to go at it. We're going to put on the gloves, and we're going to punch, we're going to fight, and we're going to argue for which way the stock goes from here. So does it go up? Does it go down? Does it go sideways? I guess there's no real sideways, so we're arguing one direction or the other. You'll get to hear both sides of it, the take, and then make up your mind. Those who are the bull and those who are the bear don't necessarily have that opinion. In the end, we'll all give an opinion of what we think based on the arguments that were made, where the stock's going to go. And you at home listening, you guys can make up your own mind. What do you think? You'll be armed with the facts to make intelligent decisions, hopefully, on these stocks themselves. So with that, do you want to flip a coin?
Yep. Gordon, your heads. George, your tails. It's heads.
All right.
Gordon, do you want to do the honors?
So that means I get to go first? Or I get to choose?
You get to choose.
All right. Well, I guess I'll go first. So
What side are you going to
I've been
take?
assigned.
What side are you going to take, Gordon?
I'm going to take the. I guess I'll take the Bears side.
Ooh.
Yeah, it's just it's always going to be my inclination.
Maybe you should just start talking about what the company does.
So Supermicro is a server company. What's a server? It's basically a computer in the cloud. It's running programs. It's running Facebook. It's running Amazon. It's it's running OnlyFans. Almost everything we do, probably somewhere a server is getting involved. Over the years, servers have been commoditized. Like there was a time like mainframes and stuff. Like these were these huge, big old computers, and over time, we figured out that it was better to just do computations massively in parallel. And so you have these big, you'll drive by the highway and you'll see like this big building, no windows, and it might be full of couple of thousand servers from Microsoft, all serving up being served as searches or what have you. But Supermicro is a small player in the server market. The other sort of known companies that are big in America anyway are Hewlett Packard Enterprise, and then you've also got Dell is the other big one. But there's been a lot of, I would say, value reduction in the industry. Basically, it became an ODM model. A lot of these guys decided that they didn't want to pay HP or Dell for the white glove service. They said, just give me the hardware, just give me an Intel CPU, let me wrap some metal around it, and I'll bring my own software. And so there's a certain amount of commoditization. I think you'll see that in Supermicro's gross margins in a minute. But basically, this is a commoditized industry. At least it's always been I think at least for the last decade or so, I think that's been the going idea is that hardware is a commodity. And here comes Supermicro, and they're saying, no, it's not. Instead of Dell and HP, where they'll give you like 7 SKUs, it's like Henry Ford, you can have anything you want as long as it's black, like it's a Model T. You can, that's kind of where Dell and HP went, and they decided to go for the enterprises that cared more about the service wrapper, having somebody they could call, and that's not a very growthy market. IT spend isn't very growthy; it's a very mature market, and they make pretty good margins. Probably 30, 40, 50% or something on selling services. Attached it to these servers. But Supermicro is not a big services company. They're a hardware company. They zigged when everybody zagged. They went public in, I think, 2007. But they're all about providing maximum selection. People are still, well, at least, a few years ago, it was mostly Intel, but increasingly it's also AMD and NVDA, obviously. These guys, they will give you 100 different configurations on day one that new CPU is available. They give the customers a ton of choice. Recently, this AI arms race has taken off, and these guys have been clear beneficiaries of it. But these guys effectively make boxes. They make a lot of them, these boxes with CPUs in them and storage and networking, all those other pieces too. They're focused on the compute piece of this world. And they're a specialist of sorts, and they're pretty small market share. I think they're most recently around 6%, which is way higher than it was a couple of years ago. That's what they do. Before I get into the case, how about I pause there for a second? Any questions or thoughts before I kind of start setting the stage from an investment perspective?
How differentiated do you think their IP is in terms of the motherboard design or the power supply design? Or they talk, I think, a lot about their ability to liquid cool their servers in a way that's more efficient and more environmentally friendly. How differentiated do you think their IP is relative to other kind of commodity players in the market today?
I mean, I don't want to talk out of school, but I think you could always look at gross margin and see that they just printed a 15% last quarter. I mean, I'm from the old school where I kind of feel like, your margins are probably the strongest evidence of your ability to differentiate, especially your gross margins, right? Operating margins are a function of R&D intensity and sales force efficiency, other things. But it's just hard for me to sit here and be like, yeah, these guys did, this thing's super differentiated and they're getting one of the lowest margins, even in hardware. All the components were getting like 30% gross margins. This is a bad neighborhood, right? Servers from a gross margin perspective are some of the worst in all of tech. Maybe best house in a bad neighborhood, and that they spend a lot more time on this. They spend a lot of time trying to squeeze energy efficient designs out, and they have this modular design where they basically can mix and match power supplies. It makes it very modular and easy to upgrade. And so they're solving some pain points. So I think it's a differentiated strategy for sure. These other companies are like negative cash conversion cycles. Like these are like cash businesses for them. They're super stable. They're milking, and these are cash cows. These guys are like, no, this is a growth industry, and where do you offer the customer choice? I don't think any of their domestic competitors have any particular desire to chase that. It's just it's not what they do. I don't think they could do it well. I think the bigger concern is just an awful lot of companies, like we would in the ODMs, like, and Hanhai, and a lot of folks in Asia that have spent a lot of time assembling things cheaply. And I will say too, by the way, it doesn't hurt to be a company that's incorporated in San Jose. In this world that we live in, we just talked about security, right? Like Supermicro themselves had a big issue, the Bloomberg news story that they have denied vehemently, that their supply chain was hacked and the Chinese, got a spy chip in there. And those servers ended up in Apple and Amazon. And so, believe it's true or not, like there's a real value, I think, in not shipping your product out of China, shipping it out of a friendly place. Taiwan is considered still a friendly place to America, but a good chunk of the production is still in San Jose. And so I would say, like, I don't know if I fully buy the technology differentiation story. I do think their strategy is pretty differentiated. I just don't know if it's necessarily fully sustainable. But reasonable can differ on that.
Yeah, a volume model, right? It's not a margin model. You got to ship a lot of volume and have fixed costs, which they're not putting a ton of money into R&D. And when volumes explode, they become much, much more profitable. That leverage starts to show. And if volumes shrink, you're in trouble. But if you're in a growing market like AI, then you've got an interesting pitch here.
Yeah, I think that's right. I want to show, I think I was going to show some of these slides maybe. Can you see this? Am I showing the slides?
Yep.
I think it makes sense to go back in the Wayback Machine for a minute and set the stage, if that makes sense.
But is that a real live Scooby-Doo van?
It's not even the correct. I was like, should be a time machine, right? All right, here we go. The Wayback Machine. This company is pretty amazing. Like, if you go back, like FY20, their fiscal year ends in 2020. They did this analyst day in March 21, and this company had just declined 5%. Rounded in the year ending June 2020. This has got a little bit of pandemic in it, right? But the year before that, not super amazing, like 4%. Here's their growth. Like, you can see that, their sales from December 18, like on a quarterly basis, they were doing around, these are millions, right? So like $1 billion in sales, and they were declining in some, a lot of these quarters. Not a lot of indication that you were going to see this like kind of massive hockey stick. Like, these guys were licking their wounds. I think an important context here too is, so in addition to that Bloomberg story that we talked about, these guys had a rev rec problem. So they basically had to go quiet with the street for 2 years, and they got delisted because they couldn't timely file. And investors hate that. Institutional investors hate that. And what ended up being, they talked about this at length, and it's public information, is that they were a little sloppy in the quarters around making sure that when it was that things, they just time stamped it at 12:01 a.m. Then this is an example, necessarily an actual example with an illustration of how it could happen, but it matters if the timestamp on the shipment is 12:01 a.m. on June 30th, or if it's at 11:59 on June 30th, or 12:01 a.m. on the next month. So, or if it gets put on a Supermicro truck, it has different revenue recognition. You can't recognize revenue until it arrives to the customer, as opposed to if you give it to UPS. Like, that sort of thing caused them to spend something like $100 million on an accounting restatement. They had to restate their growth rate, like going back like for a 5-year CAGR in their 10Q. And it was a huge mess, and they lost a bunch of investors. And so like in March 21, they had gotten relisted with the NASDAQ, and they'd done this analyst day, and they had not been growing. And Charles comes out and says, "Hey, everybody, we are going to you have no idea what's going to happen here, folks. Like, we are just going to we're back, and we're going to grow way faster." I'm going to pull that up.
Sounds to me like they've just got an ambitious team.
We talked about NVIDIA a little bit earlier, and I think a lot of people say, and I'm a believer, that AI will be maybe more transformative than the last 3 to 4 sort of step changes in tech, whether it was the mobile revolution or the advent of the internet or even the advent of chips themselves. But to date, over the last kind of 12 to 18 months, has been the gift that's kept on giving. What is your view on the kind of AI tailwinds? Will these persist long enough to continue to drive up the valuation of not only NVIDIA, but also the other technology companies around that ecosystem?
And this is going to sound really Trey, but it's like, where's the app? Like, right now, the world's on fire because of ChatGPT, which is pretty cool, and we're all figuring out how to use it. But you got to keep looking for who's making a ton of money on it, who's saving a ton of money on it, and I think it's all going to happen. But I feel like right now we're in this. When they say ChatGPT is like the most rapidly adopted technology in the history of all mankind or something. Right? And the other thing is different. This is not like the bubble where these are not fake companies. Companies are doing real revenues, billions and billions of dollars of revenues, making tons of money. And so it's not fake. But I remember I'm embarrassed to say, right, pieces I wrote about big data back in 2014. How long is, I was looking at some calls from John Chambers from 1990s talking about data was going to change the world. So I think I got to be a little, things always take a little longer than you think they're going to. And I feel like right now we're all trying to figure out how to use this stuff. And it's just really hard for us to sit here and go, okay, like I'm aiming 3 JetGPTs so NVDA can triple next year, not double. We're all making it up. And I feel like it's pretty hard to know, especially since it's not really changing my life.
I guess, do you think, though, that it seems like they turned the page, whether by their own sort of dumb luck or whether it was a genius strategy, but it feels like this market is more supply constrained than it is demand constrained in every sort of facet of the ecosystem. And the question, I think, for me at least, sitting on the sidelines here is, does that constraint go away over the next 12 months or 24 months or 36 months or 5 years? And if it doesn't, is that latent demand going to continue to propel the stock price forward?
Here's one real basic thing. We don't have visibility to all the apps that are running Supermicro servers. But I will say we do know one thing. We know they had 2 massive customers. I believe one was 25% of sales in Q3.
Even one in the teens, right? Maybe just to put it roughly.
One in the 25%. Yeah, you guys see this, right?
Yep.
Mm-hmm.
So this is from their filing. 2 customers accounted for 25% and 10% of net sales for 3 months in December 31st of 2023. So word on the street. God, it feels good to not be on the sell side. I can say things like that and not get my hand slapped. But people think it's Facebook. And it makes sense. Hey, who's been in the headlines talking about just the metaverse and building it out and spending? Here's a metaverse spend. So according to FactSet, these guys just spent $30 billion, $27 billion in 2023, which is down from December 22. And they're going to maybe grow that 20%. Just anecdotally, I feel like metaverse is not doing great. I feel like it's okay. They like Quest and Apple Pro kind of sucks, but metaverse still remains to be seen, right? It's just not a done deal. And this is a huge, I suspect, driver of their growth. And can they keep doubling that? I'm going to bet against that, right? I don't know who the other 10%er is. Maybe it's NVIDIA or maybe it's a distributor. Who knows? But maybe it's another social media company. But it really scares me to see one company being a huge amount of growth. I don't think they even were 10% last year. I mean, I'll have to double check that. I suspect the amount of growth coming from that customer is also pretty substantial. So that's always going to give you a little bit of pause. So I don't know. I keep looking for the companies that are they're screaming at the rooftops how much money they're saving or making from AI that in a believable way. And all this investment, it ultimately has to result and be justified by some kind of business. And I'm not saying that it's not, but it's not obvious to me. This is like a gold rush that's just begun and it's going to be without a stop. And it's going to be a fire hose of investment in AI and generative AI for the next few years. I was struggling to make a podcast cover for this. I'll show you some of our AI generated podcast covers. That's been my use for it primarily, is to make covers. What are you guys using ChatGPT for at work? You're in tech. I don't know anybody. People are using it for cool kind of parlor tricks, but I know this doesn't feel that real to me. People are obviously making money, but I don't know that this is going to be straight up.
I would argue, I don't want to jump too much into my case, but I'll jump in with a little bit. It's a phase of infrastructure development. And so you have a lot of, there are use cases for it, right? OpenAI has over $1.5 billion in revenue today, right? And that's your first starter. Like for a startup to grow that fast, that kind of revenue is almost unheard of, right? Tons of marketing use cases. Some people argue a lot of the tech layoffs are coming because AI is going to automate those jobs. So anytime you write, anytime it cuts that portion down. So if you're a creative, like your jobs are at huge risks here. Now, it's not quite there. Right now is the training phase. So everybody's buying GPUs, right? They're building their training models. They're trying to build those out before you're going to see the really cool applications. So like a lot of the stuff that like I start drilling at, for example, OpenAI released Sora, or there's a company called Pika Labs. These very cool animations you can type in and you can make a movie, like an animated movie on prompts. And they show Elon Musk like floating in space as an astronaut. And before to do that would have taken you hours and hours of work to create that animation. Now it's, hey, I type a sentence and it happens. Like that kind of stuff is just mind blowing to me. So I think while you're saying, hey, I don't quite see the applications there, it's because they're not ready. They're coming. And so what you're seeing, the demand in NVIDIA is the infrastructure build out. Same thing with Supermicro. People are building, training their models. The applications are going to come. And so this is that first canary in the coal mine for, I think, the AI gold rush that's coming in the application layer.
Show me the industry that is this big, this fast, that just grows 30% for the next 5 years.
We've never had a technology like this, right? That's
This
me to
time
sleep.
it's different.
I think, I think it does feel like this transfer. I mean, NVIDIA is probably the best data point that we have in terms of the level of demand that they're seeing and their ability to price. And so it just feels like, from my standpoint, like you have to be a bear on the entire segment of the market, or you have to be a bull on the entire segment of the market, because I would say it's hard for one of these companies to do really well without the other kind of ecosystem companies doing well in a similar vein, in a similar way. They might not have the direct benefit that a GPU vendor would have, but they're certainly going to have ancillary benefits. They're certainly going to see the demand in the market. The partnerships that they have with NVIDIA, with AMD, with ARM are certainly going to allow them to get some of these downstream benefits. My question is, this does feel like the type of transformative technology that will work itself out of the system over time. But for the next kind of 24 months, will we continue to see this level of demand? Meaning, is there, call it another 20 billion in revenue for this company next year, or 30 billion in revenue for this company over the next couple of years?
Yeah, and they probably have orders for the next 18 months. By the way, nothing I learned from the telecom bust. Those orders can be canceled. I don't care what they say. People rarely just take your pay, right? Anyway, it just pays to be cynical on these situations, I found. But it does feel different in that they are making money, and that I agree that it's early on. And NVIDIA is real. NVIDIA is hard to argue with because they are growing their earnings really fast, and 3 times doesn't seem that much. But I'm looking at this DCF model from the sell side on Supermicro that kind of lays out what you'd have to believe. And I think he's got like 65 billion in revenue or something in 2030, and this ridiculously low cost of capital. And I'm like, you can't justify the valuation. And then you just add to that, one day we wake up and Taiwan's invaded. We lose in Ukraine. Like, I don't want to get political, but that's the actual thing that I think is in people's risk assessment of this company. Is a huge chunk of their footprint is in Taiwan.
Yeah, Buffett walked away from Taiwan semi.
I think that's a risk to the whole chip segment. Writ large.
That in the bigger problems, we'll have bigger problems bucket, so we shouldn't talk about it. But I wouldn't take a concentrated risk on Taiwan with, when it's priced like this, right? When it's just gone parabolic and people are talking about how the sustainable competitive advantage of a 15% growth is.
On the cost of capital piece, they did just price a $1.5 billion 0% coupon bond. The first 0% coupon bond in the United States since 2022. That's a pretty cheap cost of capital as you think about where treasuries trade today. So it's
Warren Buffett doesn't get his discount rate based on what he sees in Wall Street Bets, right? Where you're investing stimulus checks that were free. Yeah, the cost of capital in Wall Street Bets is low. But yeah, I think by the way, that's another thing I'll point to here too. Look at the ownership list. It's not the who's who of mutual fund. And by the way, I'm not always a big believer in pointing to smart money, but it's like Wall Street's looking at this and going, yeah, I'll take a pass on that. And they keep taking a pass on it despite how much the top holders are passive. And then you've got funds you never heard of. And way down the list, you got Neuberger and a couple, people that are allegedly quality investors. But it's mostly non-institutional passive money that owns it, retail, a huge amount with Charles Liang, very rich man. Good for him. But
management.
It worked. It worked. It was great.
Rakesh Arora, Elon Musk, and now you got Charles Liang.
They're kind of like the same person in my mind. He needs a jacket though. He should get a Jensen jacket. I feel like there's a moment here.
I think we should all get Jensen jackets.
Put a jacket on. Like Happy Gilmore in the green jacket. Shooter McGavin. I'm sorry. It's back to the 90s movies. I can't help it.
One question
is what it is. Yeah.
Yeah, exactly. One question before we leave, though, Gordon. How would you value Supermicro? What is the right kind of valuation construct for the company?
What's their long-term earning growth rate? I think it's probably slightly above the industry. and it's super volatile, right? I feel like this is a company, they don't generate a lot of cash, right? They use a lot of cash. I feel like all the other server companies trade at like 10 times earnings. Like I'd give them a little bit of maybe a little bit of a premium to that. But frankly, there's so much risk, like geopolitical risk, and I think market share risk, and just risk of sustainability of the growth. I feel like right now they're definitely over earning, and you have to assume that there's probably a slowdown in a few years, maybe it reaccelerates. But I can't see this thing sustainably growing like 25%. Like all that growth is going to attract competitors. I just feel like I don't see a good reason to value this thing on anything other than earnings, and call me a heretic.
All right.
Got it. And so basically, like, just to sum it up, and we can cut this maybe, but so going back to our earlier conversation on PEG, assuming that the company grows 25% over the next year, then it should trade at around 25 times PE.
No, you shouldn't take the peak multiple on peak earnings, right? That's the big mistake, right? This is illusory. These guys are massively over earning. Basically, sales just grew so fast. They had so much leverage on expenses. Here's my argument. Basically, I think they probably grow earnings like 10%, 15%, maybe. It's like 15 times, like maybe more. I don't know, like what their more stable multi-year number is. It's a very volatile business. But if you look at what they've done here in terms of like their net income margin, right? It's expanded from around like 3-4% to like 7%. And almost all of that comes from just SG&A expense leverage. They went 15 to 5, right? And we can quibble about that, but for a pretty long time, like they had they were growing up at SG&A expense. There's some duplicative things in there, but like it wasn't obvious that they were going to just get a ton of leverage over time. So I would just say I would be very careful. I just don't really trust any of these numbers. I don't think anybody can look at next year's number and know what they are. They could be higher, they could be lower. I just know that I don't believe they can grow 25%. I don't believe they have necessarily a super wide moat. I think that they have some advantages, but I got to imagine that this thing's priced for perfection right now. It's hard to pick a price target. Maybe I'm being lazy and you're asking the right question, which is, what is this thing really worth? I just know it ain't worth this. It ain't worth $1,000. It ain't worth this market cap, that is in this like revenue multiple that they've never seen before. It's absurd. So I go on and on. Hopefully that maybe answers your question.
For sure. On the flip side, looking at the bull case here, we've mentioned some of the themes, but I'll let you take it over from here.
All right, Gordon, if you can hand over the ability to share the screen, I'm gonna actually walk through my presentation here. All right, I'm calling it Super Duper Micro.
Anyway, did you notice that there's like a juxtaposition? There's super micro. Anyway,
yes, super small.
There's something very acutely naive about a company that calls itself super. It's very aspirational.
Very aspirational.
I love it.
So this is, I'll dive into each of these and I'll dive into quickly, but here's the executive summary, right? So we talked about the AI evolution. Like these guys are riding it. I will say they're right on the coattails of NVIDIA right here. And so obviously people that are buying AI chips, they're also going to be buying servers for those chips to go into. And NVIDIA is really the leading indicator here of this market. And we were looking earlier about how big they're expected to grow. I think it's going to be even bigger than that. And you have a lot of analysts that are coming out with estimates that I think dwarf a lot of what has been thought here about the AI server market. They've got a small portion of the market today, so I think they seem to be gaining market share. This is now over half their revenue. And so if they can continue to gain market share in this area, they're going to be a different company than they've been historically, which is that niche player. They're going to be a market share leader in AI. And so you have a big market that they're leading the market share in for AI servers. They really have two, what I'll call competitive advantages. So one, we talked about a little bit coming up, is the ability to customize quickly. That really helps them out, for this fast moving market. They can service customers faster that really are large scale, like a Meta, for example. They're going to want things that others don't have. They have the scale that can demand the customization, and SMCI is really set up to do that. They've also been a pioneer in liquid cooling, so they've been one of the first to markets with that. That's huge, and I'm going to talk about that a little bit, what that does in AI and why you need it. I'll call them a visionary management team. I like founder-led companies. I think they tend to take a longer-term view. Look at Jensen Huang at NVIDIA. He's always had a view that his company was more than a gaming company, which is what it was originally thought to be. And for a long time, no one gave a crap about NVIDIA, right? It was just a little gaming company for video games, but he always said, no, there's more here. And so if you have that founder, you can have that long-term view. And he's aligned his pay packages. He has $1 salary. It's all equity upside. So just like Elon, just like Nikesh Arora that we talked about, like he's incentivized to drive the stock higher. The valuation is full, but I think when you look at some of those ratios, and I'll show them, PEG ratio is one we talked about, the PE divided by growth, it actually looks quite cheap. And then finally, this is one that I didn't hear talked about as much in the mainstream media, but I think the market is short. Bruce alluded to it. NVIDIA can't print enough of these things. And so right now they're constrained by the number of GPUs going into the market. AMD has arrived. They're the one other player that really, Intel to a lesser degree, but AMD is the other rival here that used to make, or does make, I should say, GPUs really for the video game market. They finally released a data center product that rivals NVIDIA. And so you're going to see supply increase, which actually isn't as good for NVIDIA if that's true, but it's great for Supermicro. So I think you're going to see really them be able to expand production. And they have new plants coming online in Taiwan to produce more here. So they're a volume business. Guess what? Volume's about to go up.
George, quick question for you. Gordon talked about it earlier, that this is truly a commodity type business. Are commodity businesses ever able to sustain elite PE type multiples, or is it more of just a timing game in terms of being able to time their growth effectively on the tailwinds of the market, but eventually they'll revert back to the commodity multiple norm?
Yeah, I feel like you're on the bear side here. It's a growth multiple, right? And as that growth slows, you're going to see them grow into it. I do think you'll see some of it come down. There is some fluff built into this, so I will talk about that a bit, but I think it's fair.
Yeah, once a fluffer, always a fluffer, huh George? Sorry, I couldn't help. Sorry, my son's in here. You may make a guess. We have we don't have child labor laws in this podcast, Frank. So my young analyst. You may hear him. By the way, it's interesting to talk about high growth. PEs are associated with earnings, right? I would make an argument too, like the enterprise. When this goes out to the whole world, I don't think they can serve it with one sales guy per enterprise, like they do with like these large cloud players. So I just wonder. I'll go back to the original pushback, which is, you can be fooled by the illusion of this earnings growth, but is it sustainable? You're really going to put a peak multiple on these unnaturally high earnings power. It's a cyclical business, basically, right? So I just don't know how you get there. This is the Kathy Woods of the world are way richer than me, so what do I know? But it just seems like it's hard to convince myself that I should hold my nose and buy this one. At a minimum, I would think I would rather own NVIDIA, similar multiple, more defensible mode. Like, why would you buy this over NVIDIA?
Yeah, I think that's a different question of, would you allocate, if you're going to allocate within the AI sector, is this the best one? I think I would rather own NVIDIA. Let me talk through the numbers here a little bit, but really I would say there's two folks that I looked at that did estimates of this market, right? It's a big market. So if you say 2023 and you looked at the kind of, call it high compute market, which is mostly AI oriented, Gartner, IDC, and then B of A put out a piece, and they were showing, or B of A put out the piece, and IDC and Gartner were really the data sources, but they saw that market as being 38 billion in TAM. That market they see growing to, in 3 years, in 2026, to 136 billion. So call it almost 4 times the size. And it's rare that you see that kind of growth in a market this fast. Northland Securities is even more bullish. They go farther out, and they're talking about a 13% CAGR growth, continuing well beyond 2026, the B of A does, and they talk about 214 billion in 2029 and 400 billion in 2033. And that's also backed up by Lisa Su, talked about AMD being a chip player trying to rival NVIDIA at 400 billion by 2027. So she went out and put that on the record and said, hey, this is a huge market. It's going to be humongous. In a lot of ways, if you think of AI as really, it's the new compute, it goes into everything, which I will tell you from my professional experience, every tech company I talk to is deploying AI in some way, shape, or form. They are becoming it's becoming part of every product. It's not going to, in a while, I don't think we're going to be talking about, hey, this is AI. It's just going to be, this is software, right? And it has AI in it, and you're not even going to say it because that's just what compute is. And so if you believe that, this is a huge market, right? And so these guys, I think a lot of the estimates historically have been too low for this market. So they're going to be able to take, if they can continue to grow share in that market, they're going to have massive amounts of revenue that they can drive. I talked about really like their competitive advantage. So it's being able to do customization and speed. And so you see, particularly in this market, historically, people have a lot of the ODMs and more generic suppliers have waited for a while for kind of chips to get adoption before they come out with their offerings. Because they have this building block architecture, Supermicro can, this new speed that exists in the market. NVIDIA puts out a chip they used to do every other year. Now they're doing once a year. They can be positioned to be the go-to for that because they move faster than all these other guys. The other thing that I mentioned was liquid cooling. So why is liquid cooling important for AI in particular? Historically, like most data centers are cooled by air. So you have an HVAC system, you have air flowing through, it's taking that heat, blowing it out of the data center. And it's a huge concern if you're running these server racks. The heat, historically, that's been able to handle it. For these AI chips, they run at they need much more electricity and they run much hotter. And so what happens if they start to overheat is they get throttled. They automatically throttle themselves. So here you are, you're paying tens of thousands of dollars for a GPU chip. And if it can't run at full capacity, like that's just money that's going out the window. And so everybody really wants those chips to be able to run efficiently. And so you need liquid cooling to do that. And so Supermicro is not the only one to ever offer that. They were one of the first. And so they've been out in the marketplace pushing this. And I think that's another reason why you see the lead here is people are needing that liquid cooling. They want their big investments to operate at maximum capacity.
I would definitely want to pressure test that. I mean, HP's been talking about liquid cooling, like Apollo systems, for quite some time. And like I really struggle to believe that there's something really differentiated there, but that nobody else can do. Again, going back to the gross margin of 15% last quarter, and what percent of their shipments are liquid cooled? I don't know, but I think it's interesting you bring that up. I just always take a grain of salt. There's always like these shiny object technologies. I want to hear some real numbers on like how important it is. And
yeah, I think it's becoming more important. The stats I've seen historically are about 1% of data centers today, because most data centers are not AI first, but you have 1%. Yeah. This comes from Charles himself, the CEO. His forecast is 20% of data centers will need liquid cooling. So there's definitely going to be an increase. Like, it's a more efficient way to cool a data center, like hands down. You just need the infrastructure to get up and running. So it's not, no brainer, let's do liquid cooling. There is some infrastructure investment that has to come in to get the liquid into the data center. But once you're there, it saves electricity. It's going to make those chips run more efficiently. They don't get throttled. Like, it's a must-have in the world of AI. But they're not the only ones to do it.
We saw this but in optics, we saw this too, right? Like, this is becoming, heat has been a problem in the data center for a long time. It's just getting worse, to your point.
No.
As we get more compute. The worst behaving part of the data center is the CPU and the GPU. And those things run hot. So I get it. But that's also increasing the cost of these things, right? The bar keeps going up. Mm-hmm. Costly it becomes.
It's a different business model, right? So if you believe that someone can make, if the volumes are here, can they be successful at this high volume, low margin business model? So I know we're running out of time. I'll try to wrap up my spiel here quickly. You mentioned low gross margins as, hey, they don't have a competitive advantage. It's commodity. I think overall that is true. I will say versus their peers, my argument would be they have demonstrated the ability to charge a premium in the marketplace. And so the chart that I'm showing shows, hey, they've trended somewhere in the mid-teens in the past, maybe gotten up to 18%. Most of their peers are single digits. And so they're doing something amongst the customization, the speed, the cooling that is allowing them to charge more than a lot of the other competitors in the marketplace. So I think they have an advantage, and I would call that evidence of some sort of competitive advantage for gaining market share. So let's talk about valuation. I think that is the one thing that's still out there a bit. And when I think about valuation, there's two pieces that go into it, right? It's what are the expectations? Are the expectations like insane? I've looked at expectations before and said, okay, PE feels high. I think they're going to blow away their numbers. Or, hey, the PE's low, but those expectations are enormous. There's no way they're going to hit that. And so I don't think you can look at a PE without saying, what are the expectations? And so if you look at this company and going further back, one of the charts you showed early on, you showed that kind of 2019, 2020, 21 period. They did have slow growth. They went through a rocky period. Prior to 2018, it was actually a growth machine off low numbers. They were regularly at a 20% CAGR. 2022 comes, they start having more of these AI applications. 2023, like those have been good growth years for them. 46, 37%. This year, they're halfway through the year because their year ends at 2024, going to grow 100%. Next year, after growing 100%, the expectation is they're going to grow 35%. They have outgrown that for the last 3 years. That's not a huge expectation in my mind by any means. EBITDA as well is going to grow in line with that. It's the streets. These are street expectations. It's the consensus for the analysts. They're not out of line to me. So that actually feels very reasonable from a growth expectation standpoint. When you get into the valuation, I threw a few comps in here. And I think what you'll see is I'd like to look at, and we can debate which is the right one. We talked a lot about PEs. I also like looking at EV to EBITDA. Takes strips away some of the impact that your capital structure can have, how much debt, etc. But on those two metrics, Supermicro is trading at, on EV to EBITDA, it's 23 times next 12 months. And then on the forward PE, it's 32 times. And so if you look at NVDA is priced around the same area. And so I would say it does feel very expensive on that front. However, what I will say is on a PEG ratio, which is something else that we talked about, and that's my far column over here, the long-term growth rate for Supermicro, and this is from analysts, is pegged at 45%. And that's actually, when you apply that, it has one of the lowest PEG ratios out there across kind of these comps. And so PEG, again, is your price earnings divided by growth. Any PEG that you rarely find PEGs under 1 right here. What I'm calculating based on this is you're taking the 32 times forward PE, you're dividing it by 45%, you're getting a PEG of 0.7. That's excellent. Now, you got to believe that long-term growth rate, right? But if you believe that TAM and you believe they can grow into it and continue to take market share, like you can get excited about that PEG. And I think, are they peak earnings? I think there's some potential there, but I think they get a lot of leverage in the model. Like they don't need a ton of sales and marketing. They don't need a ton of R&D, right? They invest what they need to put these things out. They're not creating new IP necessarily every day. Like they are commodity, but that's also part of the beauty of their model. And so I think they will be able to grow earnings going forward. And so if you believe in that growth, like you can get comfortable with this valuation.
I think that the big difference, it feels like, obviously, from what you're saying and what Gordon's saying, is you have very different expectations for long-term growth. And that impacts the valuation in terms of what you expect for their PE and also what you expect for their PEG. And so how do you respond to, Gordon's view that over the long term, this is a 15% type EPS grower, not a 40% or 45% type EPS grower?
Yeah, I think it just comes down to what you believe about the AI market. And is the data center build out going to be as big as all these analysts are saying? And if you believe AI is that game changer, like there's a lot more, like every application is going to be AI. AI is going to be everywhere. That's why you see this thing trading the way it is, right? Like it's there, it's for the taking. And I think they're well positioned for it. And my last point here I'll make, when I said up front, AMD's coming. I think this is going to be an opportunity to outperform in the near term expectations because, again, they've been constrained by NVIDIA not being able to get all the chips out. AMD is going to help boost supply, more servers for everybody. So with that, I rest my case.
I can't wait to hear what you really believe and how much SMCI you actually own. Actually, yeah, we should definitely disclose we own any. I don't own any, so I have no economic interest in the company. But I think it was well put. I think that it all comes down to it's just hard to know what their earnings power is. And I should argue this is a low, hard fought 15%. This is the shit that happens in industry. Common equipment was like that. We're just like, it's a shitty industry. It's a bad neighborhood. People get shot in watts. And people lose money in servers and comm equipment, in airlines. The industry's.
I tend to agree. I just wonder for the next couple years, right? For the next 2 to 3 years, is this nation getting gentrified?
Sorry if I
Are we
offended
bringing
you,
in a bunch of Starbucks and a bunch of bougie restaurants and changing the entire neighborhood to make it more appealing, more attractive? Is there a Whole Foods that's moving into
the
this
gross
neighborhood?
margin
That's
on
what
a
I
Starbucks
wonder.
cup of coffee is way higher than a margin on the gas station or whatever, $4 coffee versus 10-cent coffee. This is still basically 10-cent coffee, right? They're still making 50% gross margin
It,
for all
it,
the equivalent.
it might be 10-cent coffee, but there's 100,000 times more people that want that coffee now than they did last year or the year before.
And I will say the market came to them, right? Because there's a lot of custom ASICs here and custom GPUs and fragmentation, and they can be the Switzerland to a certain extent, to use a very tired metaphor. But I just got to think they're not the only ones looking at this market. I got to think HP's probably even kicking themselves going, dang, did we really need to leave the web scale business? Microsoft was really a bad boyfriend, but I think they're thinking about calling him back. I think that's a lot. If I can get that kind of multiple on my server revenue, Lord, they have liquid cooling technology over there. They can dust off their relationship with Intel, get back out there, get back in the heat. I don't know, man. Like, it just feels like they're going to try competition. This is going to be before the end of this year. The stock is going to be like below $500 or something. It's going to be a very bad day. It may go to 3,000 first because that's just the nature of my. But I think it's going to end badly. And actually, I should call it on this year. It feels like there's so much. We might have 18 months to go, but when it ends, it's going to be spectacular. And people wonder what they were drinking when they were rolling out the same old BS, but this time it's different over and over. I hate to bring up the bubble, but there's been other ones, little sort of mini bubbles along the way. And I agree, it's not a bubble, but the valuations are getting a bit heady. And I just feel like the economy is only so big at the end of the day.
So, should we just go around and say what our actual view is on SMCI?
Mine, I think, is pretty clear. I do very good acting jobs. I just can't get over the valuation. And I think that it's not a quality business. So that was a real opinion. Happy accident.
Yeah. So I think I'm in a similar camp. I think that the demand pipeline for AI today is so strong that it's going to lift a lot of these stocks across the kind of broader artificial intelligence ecosystem, from the chip makers to the companies that are delivering the service, like the Palantirs, for example. I think every kind of company in this market is going to be a huge beneficiary. I don't think many of these companies have ever seen demand like this before or pricing power like this before. And so I think for the next several years, they'll be able to command a premium, both in terms of their pricing and in terms of their multiple. And so I think that growth for the next couple of years, both at the top line and the bottom line, will be really strong. And so maybe the long-term growth rate for the company won't be 35, 40, 45%. Maybe it will eventually trend back down to 10, 15, or maybe 20%. But I think for the kind of foreseeable future, as the market's thinking about pricing in near-term demand, as the market's thinking about what revenue looks like in the next couple of years, there's, I would say, probably between 20 to $40 billion available to the company in the next couple of years that will trickle down into some form of really strong sort of EPS growth. And I think PEG is actually the right valuation metric to use here. And if you take the rough numbers of what they've done over this past year leading into 24, and as they flip into the fiscal year 2025, I think that they have a chance of doubling EPS this year, basically from going from 11-ish to 22-ish, and then next year potentially even going from 22 to 30 to 35. And if you take a 40 growth rate there in the next year, we take a 40 times multiple, you get to $1,200 to $1,500 for the stock, and then in the kind of near term. I just think that the market is there, and they're in the perfect place at the perfect time. The company started 30 years ago, so it's been an overnight success that took them into a bunch of different places, but eventually landed them in the cradle of AI, which is going to be a huge kind of benefit, I think, to everybody. I'm a short-term bull here. I think this is a story that's super compelling. I think that NVIDIA is going to lead the way, but these guys are going to be huge beneficiaries of everything that's going on in the tech ecosystem. Over the long term, I think it does get commoditized away, but I think there's a real opportunity to make money here over the next kind of 2 years.
And I would say maybe as we do them too, let's say a short term and a long term. So short term, I think, is probably like 12 to 18 months. Long term is beyond that, obviously 2 years beyond. I'm happy to give mine. So I would say, I think short term, as you alluded to, Gordon. I do think there's runway here. I do believe in that AMD point. I think AMD is going to do well in the market, which is actually my solicitation for a buy on AMD. And to disclose, I am an owner of AMD stock. It's one of my largest positions. And I think that's going to give these guys a boost, and I think they'll be able to perform, right? Like the AI train is not slowing down. So short term, I think they can outperform those growth expectations that were there, and I think they'll do well. Longer term, I agree with the commoditization. That's a crappy market. There's no differentiation. I think people are going to see the profits and they're going to come running, and they're just going to have more and more fights. And so that's going to drive margins down, and they're not going to necessarily run away with this market. So I wouldn't be a long-term holder.
I think pretty positive notes to end on. I say maybe we leave it there, and agree to disagree. I'm going to be shopping for some long-dated puts to lose money on.
Keep up the track record.
I don't want to break the streak. There's always more money to burn.
There you go. Maybe the good ending is thanks for joining us. Bulls make money, bears make money, pigs get slaughtered. And you have it. Thanks, everybody.
Say make money, money, make money. Make money, money, make money, money. Money makes the world go round. I'm the talk around town. Remy gave me the sound.